Welcome, Metalheads. I'm Brad, and I'll be your host as we do a no-bull deep dive into the world of the gold buffalo. This exploration will take on several parts, including the history and minting, as well as the mechanics of price over time. So buckle up and settle in as we go into the weeds on our hunt for the buffalo. If you are familiar with my daily video update on precious metals markets, then you are likely familiar with the numerous times I've called out the gold buffalo because of its movements away from the pack of other gold coins and pieces. It's this that really drove my interest in pulling together the data and visualizations to get under the hood and see why it behaves as it does. In general, as I examine data of this type, especially as I look at the broader markets, I live in relative values as opposed to absolute momentary values. My reason for this is to look beyond incremental price change and take a longer, wider view. So when investing in something, I want to see relative performance over time. What can I expect over the next year, 5, or 10? It's in this analysis and examination I noticed the buffalo moved outside the pack of other benchmark pieces that I use. So let's see if we can't see why. Let's also try to figure out if this is a worthwhile investment. Back in December 2005, President George W. Bush signed into effect Public Law 109-145, titled the Presidential $1 Coin Act of 2005. This act recognized that despite the economic need for a $1 coin in certain segments of the market, previous attempts at public adoption had fallen flat. No one really warmed up to the Sacagawea $1 coin, so the government said, hey, let's put presidents on a series of coins. Maybe it'll drive collector interest. I mean, it worked with the 50-state quarters, right? Well then, because they wanted to pass one issue, and if they're going to go through all that trouble, they better make it worthwhile by adding in some other stuff. So they added in Section 103, which is the first spouse bullion coin program. This section provided for a 0.5 troy ounce, 99.99% pure gold coin at the same diameter as the presidential dollar, minted with the likenesses of presidential spouses on the obverse and given a $10 denomination. But under Title II of the Act, Section 201 provides for the minting of a $50, 1 troy ounce, 99.99% gold coin with an obverse design of the original James Earl Fraser 1913 Type 1 Buffalo nickel. Hence the buffalo was born. So an interesting fact, Section 201(4)(a) described the source of gold, and quoting directly from the law, the Secretary shall acquire gold for the coins issued under this subsection by purchase of gold mined from national deposits in the United States, or in a territory or possession of the United States, within 1 year after the month in which the ore from which it is derived was mined. So in other words, to translate the legalese, all the gold in a buffalo comes from a United States deposit that was mined within the past year. Subsection B of that same passage goes on to designate that the government cannot pay more than the average world gold price for the gold purchased. So we can say at least someone's buying precious metals at spot. Am I right? The gold buffalo, like any sovereign mint coin, has very rigid specifications. These are: content is gold, 1 troy ounce, or 31.1035 grams. Its weight is 1.0001 troy ounce, or 31.108 grams. Its diameter is 1.287 inches, or 32.7 millimeters. Thickness is 0.116 inches, or 2.95 millimeters. So in terms of design, the obverse includes the legally designated design of the 1913 buffalo, as well as the word liberty and the year. The reverse includes United States of America, E pluribus unum, In God We Trust, $50, and 1 ounce, 0.9999 fine gold. All of these coins are produced at the West Point Mint. However, only the proof editions will bear the mint mark. In terms of sales figures, on the graph, we can see that the highest point was actually at the first year of issue in 2006. It had spiked at certain points and declined, but overall we can see that as it starts moving into the year 2020, the volume has increased considerably. And not shown on this graph is the year-to-date 2021 figures, which at the time of production stands at 200,000. If that trend continues, we can expect the production could reasonably exceed even the 2006 high water mark of 337,000. I don't care who you are, that's a lot of gold. Before we dig too far into the analysis portion, let me name a few caveats that are relevant. First, my price data is far from complete and should not be taken as authoritative. It can be used as a guide, of course, but there are gaps and limits to what I can collect. Second, my pricing data for this particular coin only goes back several months at this resolution. Past performance does not guarantee future results and all that. Third, before making any investment decisions, talk to a licensed financial professional in your locality that understands your goals and situations. In other words, don't get your investment guidance from a dude on YouTube, no matter how suave and cool he appears to be. So with all that out of the way, let's get to it. And the first view I want to look at is the high-level aggregate. This is the average price chart for the item over the period. Now this chart provides a view of the observed high and low prices, as well as an average of all observed points and median for those same points. So just to provide a little bit of background on this and hopefully make you understand it a little bit better, we'll have a quick statistics refresher. Now don't get too upset or, apprehensive about things. It's not that bad. So what is the average? The average is the sum of the observed prices divided by the total number of observations. It provides a nice view that gives a quick idea where the price falls. The downside is that it is easily pushed and pulled by outliers at the extreme high and low of the observations. In this context, this means that I'm taking all of the price data, I'm aggregating it all together, and I'm deriving the average off of that. Now, the high and low price are direct observations, so those are absolute, but the average is just the aggregation of the others. The median is a simple evaluation of the center of an ordered list. We take all the observations, sort them from smallest to largest, and grab the middle value. Together, the average and median provides a good description of the data set. Depending on where both values fall in relation to each other, we can learn a lot without diving too far in. So we can see that just as the average is pulled and pushed between the high and low ends of the spectrum, the median isn't. It's relatively agnostic according to that. So we can see overall the entire price distribution based off of this average type of chart. Now, if we look at this chart, we can see that going all the way back as far as April 27th, when I first started collecting this data at this resolution, we are looking at an average price for a gold buffalo across all distributors of $1,981.44. The median was $1,963.62. We had a low price of $19.28 and a high price of $2,107. So that provides a pretty good range, and we can see that the actual average and the median fall much lower than this higher end price. Now, as we move across and we start looking at all of the dates, we can see that there's some price variations that go on. We have these interesting spikes that go from the lows that are momentary almost all the way to the highs. And again, because we're looking at this at such a large scale across from April 27th until, today is July 8th, we can see that this is all, that we aren't seeing a minute by minute resolution really. What we're seeing in a larger resolution. So we're not getting exactly what the spikes are, but we can see them on the graph. They are being noted. But we can see that even at the higher end, the price tends to spike quite a bit. It goes up from, down here at 2135 all the way up to the 2200s and carries all the way into the 2230s and even into the 2240s. But that drops again. And that was around June 3rd, and that pops back up. Now that carried through all the way until June 16th, where it then dropped again. And we start seeing where the prices start to fall back down to the 2000 level, 2092 at the high. But as we start moving into the closer range of things, we can see that, as we reach the end of July 8th, we have a low price of 1946.37, high price of 2110.39, and an average of 2008 and a median of 1980. So even with that, there's, $28 price difference between the median and the average. Now, next up, although this provides us a good view, we want to dig in a little bit. So the next up on the list is, let's see where the actual prices are. This is the gold item price chart, and it shows the price at any period from observed distributors. Nothing is too complicated. I've basically taken all the distributors that sell the gold buffalo that I collect, and plotted them on a chart and seen where they fall. And this tends to inform a lot of what we're trying to do. And one of the things that we'll notice is I've actually blocked out both Kitco and Buy Gold Silver. And Buy Gold Silver and Kitco, I did take them out of this just because, as you can see, Buy Gold Silver has been a consistent price point. They haven't changed. Whether that's true or not, or a possible inconsistency within the data being collected, it's hard to say, and I haven't dug too far into it because it is such an outlier. So for just simple purposes, I've actually removed them from this. And we can see the big distributors: APMEX, Gold Silver, JM Bullion, Provident, SD Bullion, and Silver.com. Additionally, I've also plotted the spot price as well, so you can see the relative movements according to spot directly. Now, something to note here, which isn't normally known, although it's not really a secret in the industry, is that JM Bullion, Provident, and Silver.com are all owned by the same company. They're owned by a company called A-Mark out of California. So all of them, you would assume, would have a very similar price movement to the way that they are. So let's take a quick look at just those three. And with those three, we can see an almost exact match all the way across. And a lot of times what winds up occurring, especially with these bigger distributors, is the flat line indicates that they have a price, but they don't have necessarily in-stock items. So they haven't adjusted the price, they've just made them not available for purchase. Unfortunately, it still does tend to show up on my data collection. But we can see this throughout June. Getting in, we saw that by that point, JM and Silver.com both had pricing, so they both had in stock inventory, and it moved from there. But what's interesting to note is that Provident tends to be most expensive. There is, $25 difference between JM and Provident. JM sits right in the middle, and Silver.com sits right at the bottom. Now, all of these are coming from the exact same distributor. They're all coming from the same company. So as we start to look at this, we can say that if we order from any one of these three companies, it's all the same items. That there isn't too much differentiation between it except for price. So if you want to buy from Provident, you're going to spend more. But the exact same piece comes from Silver.com. And it does tend to be significant. So when we add in a company such as APMEX, we can see that they're significantly higher. Almost exclusively, they brush right against that $2,100 mark, oftentimes going up above $2,200. So if you remember back to the average price chart, you can see where that high range was coming from. But even that's significant premium over the spot price. I mean, we're looking at $350-ish, somewhere in that neighborhood. So if you really want to buy from APMEX, you can. And SD Bullion tends to sit right in the middle. SD Bullion is their own company, so they have their own different distributions of pricing, and how they tend to approach things. But as we start to look at this, we can see that this pricing sits squarely in the middle between even the Provident pricing and the AppMex pricing. So our next journey is going to be into the relative and comparative performance of the item against spot. And this is the actual graph that actually caught my attention. And a lot of times, this, especially when plotted in the aggregate against other benchmark pieces, the buffalo tends to move differently in relative proportion against spot. So I've broken out each of the aggregate prices into their individual distributors again. But in this particular instance, I'm not looking specifically at the price. I'm looking at the relative variance and how much above or below it's actually moving according to the movements of spot itself. And one of the things that we can see on this is that there is a lot of variation that occurs. So gold, silver tends to move significantly different. We see AppMex tends to actually kind of lag the actual movement, although their absolute price is much higher. So let's pull the outliers out and look right in the middle and see exactly where JM, Kitco, Provident, SD, and Silver.com fall. And even if we pull out Kitco, because they kind of noisy up the chart a bit, we can see as all of this takes place, they're moving roughly equivalent to spot. And Provident is definitely an outlier there as well. But when we start to look at just JM, SD, and Silver.com, their relative price movements are pretty much similar. So the other view that I have is very similar to that. This just takes spot, and instead of treating it as a dynamic moving fixture, what it does is it actually centers it at the 0 point. So everything is placed in relation to that, so we can see the differential between the individual movements for each distributor a little bit clearer. And again, if we start to clean up the noise, because we're still seeing the same movements, we're seeing gold and silver up here with these wide moves, and we're seeing AppMex down here. So if we remove AppMex, and if we remove gold, silver, we can then see that, things start to hover a little bit closer. And especially with Provident on the bottom, again, Provident has the higher price of those three companies. We can see that the average tends to float right around where the spot value is. So they've basically set a price, and they're pretty rigid about holding to it. There are some differentiations around here. So if we remove Kitco, and if we remove Provident, and we're just left with JM, SD, and Silver.com, we can see that there are some incremental price changes that occur. So back here, back in May 7th, we saw a dip that occurred. We also see one here. SD tended to drop for a few minutes, and so on and so forth. But on average, you can see that everything is pretty straight within the plus or minus 0.5% of spot movements. So you can say that this adheres pretty religiously to the way that spot moves. Now, the final thing that I want to bring up is actually the scatter. So let's actually look at this, and this bears a little bit of explaining. So I find value in taking the price and divorcing it from a time series. And what we've looked at previously has been the time series data of where spot has fallen at a given point, and where the incremental prices have been, whether that's been just in performance or differences from the spot price, or if it's actually been something that is the actual absolute price. However, a graph such as this, when you divorce it from just that time series basis, it allows us to identify the correlations between item pricing and spot and perform some predictions. So in the case of a place like JM Bullion, which I have up right now, we can see a very, very linear correlation, which is something that kind of I was alluding to on the last graph that we just showed. There's not a lot of divergence from the regression line, and it's not too far out of line to say that if spot is X, then the item price is going to be Y, at least under the current regime. The way that they've established their pricing levels and the actual unit price for the item, it has a very direct correlation. So we can see that down here, when spot was 1753, the item price was 1929. We can see up here that again on that same line, that when spot was 1918, the price was 2091. So we can actually carry that line straight forward, and we can predict almost with reasonable accuracy that if spot were to hit, say, 1950, or if it were to hit 2000, where would the price of the buffalo be? And that's important to look at, and it's not something that I've carried out in this analysis, because I think that would be challenging to explain and display, but it is something that allows us to kind of work with this. So if we actually shift over and we see Provident, we can see pretty much the same regime. It's a very straight line. It's a very direct correlation. The same as if we go silver.com, we can see that same type of movement. There's a slight bow, but for the most part, everything is very straight. We can tell exactly where the prices will be. With SD, there's a little bit more pricing distribution. We can tell because of the colors that are used that show it exactly where the proportional gap is between spot and retail. But however, on average, that line still continues up. So it's very possible to look at a company like SD and be able to possibly find the right deal at the right time for this particular unit. Although, as you recall, the price for SD actually fell between the upper end of the spectrum, which was APMEX, and the bottom end of the spectrum, which was Provident in this particular instance. So if we look at APMEX, this is where things get a little bit different. We can see several different price regimes that have occurred within the way that they price their product. As the dots are smaller, it indicates that they're farther away from the present. So when we start looking at this, we can see that farther ago, we can see that back in say May 13th, the price for spot was 1810. The price for this was 2099. It was also within the lower level of where the pricing distribution fell. However, as we start getting closer and closer to the current period, we can see that the pricing started to rise to this upper level of a much bigger distribution, or a difference between spot and retail. And then, of course, we start moving into something like this, which is this point right here. On the 6th of July, spot was at 1802, and the price was 2110. And this falls right in that center range. So it means that it's relatively fair. And we can tell that from this line, it's not a straight line, so it's hard to really gauge exactly where it's going to go or predict it on a consistent basis. And that's part of the challenge of it. So where does this leave us? So part 5, conclusion. So is the buffalo a good buy? Is it worth investing in? Now, I hate to be that guy, but I have to leave it up to you to make that determination for yourself. For me, I'll give my own personal opinion on it. I have a number of downsides that steer me away. First, it's aesthetics. I'm not a huge fan of the design. Likely it's because I'm from the Buffalo area, so I'm pretty inundated with bison imagery. It's just something that, doesn't appeal to me as a collector. But second, and more importantly, it's a very premium piece. It sells for much higher than other comparable 1-ounce gold, like the maple, the Philharmonic, or even the eagle. And while it sells higher, it can be assumed it will resell at a higher value. But unless there is an underlying upward adjustment in price of gold, it's questionable whether the acquisition cost can be realized down the road. So to me, it falls into the same category as the American Silver Eagle. It's nice and backed by the US Mint, but it's a spicy meatball in terms of price. It has a higher risk profile than other pieces. It's not assured that I'm going to be able to get my acquisition cost out of it. So for me, I'll likely stay away, at least on the primary market, and unless a very good deal fell in my lap. I'm never going to turn down a good deal, but it's not something I'm going to go out of my way for. However, for you, it might push just the right buttons, and that's fine. We all have to stack our own stack. So with that, I'm going to wrap this up. If you enjoyed this content, please like, share, and subscribe. This channel has a daily overview of the metals markets with a deeper dive into the mechanics of the market than you will find anywhere else. I go into a lot more depth and a lot more charts and try to really dissect what's happening and try to give an intelligent view of what's going on and cutting through the hype and the bull. So until next time, happy stacking.